Risk management 101. So first and foremost, hello to all of you, and I hope that you are doing well in these markets, because I mean, it's a tough market, there is no doubt. Those markets are volatile, and at the end of January, start of February this year, I decided to look at what kind of topics I could have done for the next webinars, and I looked at risk management, and actually that was a great idea, a good idea. And as most of you know now that you are trading, timing is everything. So doing this webinar, I think it's going to help a lot of you. So 2 weeks ago, there was a lot of euphoria in the market everywhere. And many people now can see how hedging important is. So why, and one of the first reasons why people are failing and retail traders are failing is because they have no risk management in place. And that sounds a bit boring. And here I'm not going to sell you the Ferraris and the traveling and, you know, going for 10 days somewhere. It's going to be risk management 101. And why are they losing money? Why are we losing money? It's because we have no diversification. We have big leverage. We have no hedging, and we rely on one strategy. And more importantly, we don't have stop loss. So in this webinar, I will share my experience as both a fund manager, prop trader, and as an educator for the last 5 years. And I want you as much as possible to avoid those rookie mistakes. And by doing so, hopefully, pretty quickly, you're going to start to be making money. So as I told you at the start of January, January, start of February, I was raising red flags on the possibility of you know, people being very complacent. Why being complacent? Because the trolling on Twitter was at all-time high. And you had people pretending to be running portfolio for years and years, and actually when you were checking, they were only on Twitter for the last 6 months. So I have nothing against them, and we are all having a different learning curve. But that tells you a lot about, you know, how was the risk management and the hedging done until a month ago. So you always need to hedge yourself, but when it's happening, you're going to realize, and most of you probably have realized over the last couple of weeks how important that was. So here I just want to be optimistic and to be positive, because I strongly believe that if you follow the correct risk management, you could do well. And for the rest of the process, like ID generation, price action, timing, and this is for all of us a non-stop learning curve. So if you're telling people that you know all of this and you're completely fine, you're just lying. Literally, if you want to be successful over the years and non-stop, this is really a non-stop learning curve. So despite all the doom and gloom of this coronavirus, which I think is overdone, but you have to respect the price action, we need to cheer up a bit, and still, even if that could sound boring for some of you, risk management is here for a reason. So I would like to start first with the myth versus the reality. And as a quick introduction, and to sound less boring, I hope, I just want to let you know that one of my first trades that I did like 20 years ago was very painful. So to give you an example, that was in the year 2000, so 20 years ago, literally 20 years ago. And I was doing this internship for 3 months for a broker in Paris. And that was the internship that I had to do for my business school at the end of the 3 years. And literally, as many internship when you start in a trading room, I was answering phones, learning DCF models, and probably making many coffees. And every day from January to March 2020, I was hearing, you know, the brokers pushing for stocks, like the tech stocks, the telco stocks. And I was looking at those stocks, and every day they were looking up. Same as what you had recently with people buying calls on Microsoft, on all the tech companies. So obviously you are kind of thinking, okay, what about I do the same? So I jumped and I bought at once. At that time, the stock was called Equant. So that was a telco stock, and I bought, if I remember correctly, I bought the stock at 190. And what I did, like most people do when they start trading, we go a bit leverage, obviously, because we want to be making big money and we don't have that much capital. And we are putting all our money in one story. Okay, so I went leverage on Equant at 190. And I think very quickly the stock started to come down. So first you're in denial, then you get the margin call, you need to put more money, and you get stopped out. Okay, so the first lesson of trading on your own is two things: concentration and leverage. And I learned the hard way. And make no mistake, I mean, I've not been the only one. You probably 90% of the people that are here today have done the same mistakes. And the question is how to solve this issue about risk management. Okay, so last Thursday, I had an advanced webinar for existing mentees and subscribers of the 4x4 video series. So here we're going to have an introduction. I'm going to be using slides that I used last week, because to me, risk management, again, even if it sounds boring and I'm not selling you a dream, this is something that you can't miss. And actually, if some of you want to be working for a hedge fund in a prop trading shop, this is the first thing that people will look at. So ID generation, yes, obviously people will enjoy it. But if you don't have a good risk management, and if people can't rely on your risk management, then they're never gonna hire you. Okay, so myth versus reality. I think you need to understand and figure out, adjusting your risk depending on which asset class you are trading. So that's going to be for the next slides. The second point, which I just discussed, is the leverage. How much should we be using when we get access to leverage? Then diversification versus concentration. How many percentage of our portfolio can we put in one position? Something that is really September to February, which is most people will have told you, hedging is for sissies. That's a good question. I mean, that's always the joke when you're a trading room and you put a position and the other trader asks you, did you put any hedge? And you say no. And then the guy look at you and say, yeah, okay, hedging is for sissies. And if you put one, he look at you and say, actually, you put an hedge against it. At the end of the day, it's all about risk management. So we're going to make a quick introduction to beta, and for some of you, maybe you're going to discover what is beta, but it's extremely powerful, especially in the market like this. There are three other points that we are not going to cover today, which is the hit ratio and average winners versus average losers. So that's well covered in the 4x4 video series, same as the whole risk management stop loss. So the concept, and it's more than the concept, say having a hard stop loss on a single position and on an overall portfolio. And why I'm saying that, because I had many people that came to me and have been using different system, other video series, ID generation, they were struggling, and they were even more struggling on the risk management. So they came to me, I've been trading for 1 to 5 years and not making any money, because each time there is a blip in their strategy or in the market, they are losing a lot of money. So the whole idea is to try to fix this big issue of the risk management, and then obviously helping them as well on the ID generation. Then as well in the 4x4 video series, I like to using futures, ETFs, and options. So this is well covered. Unfortunately, for time reason, we're not going to have time to look at it. Okay, so adjusting risk depending on asset class. Again, this is something that is key to me in the 4x4 video series. So when, let's say, the first 5 videos, we are looking at how the different asset classes and assets are doing versus historical volatility, and what you put when you put historical volatility versus realistic expectation, and meaning you'll be looking at implied volatility. And based on that, we'll be adopting a good risk management. Reality, and maybe not for all of you, most retail traders will start trading FX. Over the last, let's say, a couple of years, many retail traders as well have been doing cryptocurrencies. Why? Because if you look at what the brokers are offering, they are pushing hard for the FX market because it's offering huge leverage. So when you tell people you can be leveraged 500 times, and they say, okay, 500 times, if I make 1%, then I'm going to be very rich. But then you're thinking, okay, it's very easy. The reality is very different. And you know the numbers when we're trading FX, when people are trading FX, they'll be losing 90% of the time. So what is the reality is you need to be looking at a universe, if you're talking about FX, which is much smaller than the equity world, with less trading opportunities. So to give you a full background, my background is mainly into equities. Okay, so I trade 80 to 90% stocks. I trade other asset classes, but I think the equity world is offering so many opportunities that literally this is probably the best in terms of returns and opportunities. So what you have is people are trading low volatility. If you're looking at, let's say, euro dollar FX, where you have many participants, and very quickly those people are using crazy risk management, where they will be using 50, 100, or 500 times leverage. So as we will cover in the next slides, when you have 100 times leverage, it does not matter which size you're carrying, because after 1%, you're out. So if you think about in the US, you can use 50 times leverage on major currencies and 30 times in Europe. That tells you why and how quickly you can be losing in FX. So trading FX, I take the example here of 50 times leverage, which is what the US regulators are offering. So if you look at the euro dollar, let's imagine that you open an account that has a size of $5,000. Okay, so $5,000, if you leverage it 50 times, that gives you access to $250,000. So far, so good. So let's say that I buy $250,000 and I sell the euro at 108.25. So that gives you $230 euro roughly. So that's the chart here. So let's go this way. Let's do the pen. So if we sell the dollar here, so if we buying the dollar and selling the euro, so the first thing when it goes down, unrealized P&L, you're going to be making roughly $900. So here you feel really good. But then what happens is actually dollar is weakening, euro is strengthening, and at 110, you're down $4,000. Then at 110.41, game over, you're out. Okay, so 110.41 versus your entry price at 108.25, that's 2%. So what does it mean? I mean, you all know that, or maybe not all of you, but after 2%, you're out. And we are not talking like crazy move. If you think that the daily move of the euro dollar could be 70, 80 bips normally, that means after 3 days, or let's say 72 hours, you're out of your $5,000. Okay, so let's do the same now with trading index, where we're using 20 times leverage, which is what, and again, this is for educational purpose, and we assume we can buy the full amount. So I take the S&P, and I'll be same. I get an account of $5,000, leverage 20 times, and I'll be buying for $100,000 worth of the S&P at 32.80. Okay, so 32.80, that gives you, okay, so let's say we're buying here, there is a gap, I want to buy, it's beautiful, it's going to go higher, it's going to go higher. So at 3,000, so sorry, that's the 4,800, you're going to have the P&L of 3,300. Okay, so far so good. Then suddenly it starts to come down. So you're only down 1% on the chart, and you're already losing $1,000. Then it carries on, and here you're going to be over, game over, after this move of 160 points. Okay, so as you're using a 20% leverage, after 5%, you're done. And as you can see, it's not, yes, the market has been moving big these days, but still, that means 10 days after putting your position, you're out. And that means when the market is moving, when there will be opportunities, it's going to happen without you. So literally, you're going to be out of this market. So what you need for leverage is linked with concentration and diversification and the possible moves. So what you need to be doing and following is something that we're going to check after, is you have to be calculating the daily average true range, or the ATR, which is the average true range, for the assets you would like to trade. So if we are trading daily, we're going to be looking and checking the daily ATR. If we are trading with a weekly time frame, monthly time frame, obviously the ATR are going to go from daily, from weekly to monthly. And I think what is important, you need to have the big picture. So what I do always when I trade an asset, I try to look at the worst case scenario. So I will be looking, let's say, for the last 20 years. And the good thing, if you look at 2008, 2009, those are the biggest moves that we ever had. So that's going to tell you what's the worst case scenario. Yes, it's going to happen, 0, let's say, or 1% of the time. But when it happens, if it happens against you, you're going to be out. So you want to make sure that you know those moves. So from this, you will know by how much the assets could be moving and what was the biggest move on that day. If you cannot keep that position without going out, then obviously this is not a trade. So let's look at the adjust risk by asset class. So here I've been looking at index. So I even put the Bitcoin because I know that some of you have been trading Bitcoin, and if they are listening to this risk management, it's probably because over the last couple of years I've been losing money. I've done some FX, bonds, then we have commodities, and we have some sectors as well. So as you can see here, I've put the average true range, which is again the indicator that measures the historical volatility. So if we start with the the stock indexes, and those numbers were calculated 2 days ago, a couple of days ago on Thursday, they had an ATR between 2 to 3%. Okay, so roughly they are all more or less all the same. So that tells you that when there is an increase in volatility, there's going to be an increase in volatility across all most indexes. And then you have Bitcoin that is living in its own planet, and the reality is because the bid offer are very huge, and because of let's say counterparty risk that there is, so there is much more risk, meaning that you gotta have much bigger moves. On the currencies, you can see that the currencies are at 1% or below. That has been increasing over the last couple of weeks, but still, that is 2 or 3 times less than indexes. The bonds, same thing. If you look at the TLT, which is the 20 years for bonds ETF, it has been massively shooting up, and the implied volatility the same. But normally, based on the asset class, that is lower. And then commodities and sectors. So that tells you when I'm trading something, which kind of risk management and positioning should I be following. When we're looking at stocks, indexes, and single names, we need to reduce the exposure versus something like the FX, where the implied volatility, the historical volatility, are much lower than this asset class. So let's take the example of the daily Bitcoin ATR. Again, don't blame me if you don't like Bitcoin. This is not the point. The point is not about saying, Bitcoin is good or bad. I'm just trying to understand what is the risk management. So, and I know again that many of you today have been trading 2 markets, which have been FX and cryptocurrencies. So if you look at ATR, the ATR over time, the daily ATR of the Bitcoin, you can see we had 2 spikes of 10%, which are here, and literally you are around 4 to 5%. So if, let's assume that you're using a 20 times leverage, if you are using a non-regulated broker, and if we are using this line, which is 5%, you could be literally stopped out of all your money on an intraday basis, okay? And I know that some of you have done that, okay? And here it's not about the blaming game, it's about trying to find a solution. So on the ATR, it tells you, the ATR is not going to tell you how the volatility is going to be next. It's not, so implied volatility might help you. By no means it's going to tell you what's going to happen tomorrow, but at least that helps to understand how volatility has been recently and over the last couple of years or more. So if you want to have access and to be able to calculate ATR, I mean, this is not rocket science, please send me an email to this address, contact@gregoiredupont.com. Just tell me that you were part of this webinar, and I'll be happy to send you an Excel spreadsheet where you could be calculating the ATR value. So I hope it's going to help some of you. So same here, if we do look at the S&P 500 daily ATR, that's the same chart, but here over 12 years now. You see the spike that you had in 2008, 2009. This is where we are at the moment, okay? So there is on one hand, these days, the doom and gloom, okay? So we should all stay at home and not touching anyone, not going to the gym, not talking, and just being in a bunker. I think obviously this is way too much. But on the other hand, you can argue that we are far from the end of the world in terms of volatility, okay? You still get this way to go. And I'm not calling about this way to go. I'm just saying that this is your worst case scenario. And actually this worst case scenario lasts for for almost a year. So be careful on thinking, okay, this is the time to buy, this is the time buying, shorting the volatility. I see some people saying, oh, what about you go short implied volatility, blah, blah. I mean, I've seen people going short implied volatility in 2012 when the Italian banks went under, not under, but under a lot of stress. Same in 2008, 2009 with Volkswagen. You need to be careful. So don't go for those silly calls that you can only do if you are very advanced traders. So the first thing that we've seen here is diversification versus concentration. So before that, that was the leverage, but linked with the leverage, you get diversification versus concentration. So before doing anything, this is where we should all be starting. What we have, and this is one of the struggles that we all have, and I can see that when I do the mentoring program, is we have many traders that come to me and say, look, Greg, I have an idea. I want to be buying this or selling this. And actually, after 1 hour of mentoring session, they tell me they realize this is not a trade, and actually they need to wait. But before having a good risk management, we look and say we have an idea. What about I go for a trade? And we go all in. We go all in leverage and one position. And the reality is, again, it's boring, but that's true. Asset classes have different correlations. Asset classes have different risk-adjusted returns, and here this is important. So this is something that I cover very well in I think this video 3 of the video series. Is you need to have realistic expectations depending on which assets you're trading, okay, and depending where you are in the economic cycle and where you are in market condition. The good thing is the cost of trading for diversification is no longer an excuse. So when I started to trade, literally, you were trading, let's say, 1% when you were trading with a big bank. Even, let's say, 5 years ago, the cost of trading was pretty high. Now it's close to zero. Even if some of you are still paying crazy commissions because they are using dodgy brokers, but that's another problem. Meaning that even with $2,000-3,000, you could start to diversify and having a diversified book. Okay, so you don't need necessarily to be bigger. I mean, even if it's better, but you can start with a smaller amount. But the first rule that I want to give you, and there are many more, but this is the one that I use first, is you don't want to have one stock position representing more than 10% of your book. Okay. And you don't want to have first a net position long or short of more than 30%. So let's say you get $3,000. You don't want to be long more than $900 or want to be short more than $900. It might sound boring, and actually people would say, how I'm supposed to be making money? I know how you could be losing money more quickly than making money. So it's about learning. It's a learning curve. Again, from my experience, many people start, 5 times leverage all in. Then after 2 to 3 years, they come and say, look, Greg, I've been struggling with the risk management. How could you be helping? So again, as I said, I'm not, I don't want to be the grumpy guy. And this is something that I've done. And we all did when we started trading. or managing money. And if you can avoid these things where you can be losing $3, $5, $10,000 because of its leverage and concentration, that will be a great achievement. So again, the cost of trading is no longer an issue, and that means you have no excuse. Stocks, no more than 10%. For FX and commodities, you could be bigger, but why you could be bigger? Because 5 days of the week, they are trading 24 hours. But over the weekend, they might then be opening with the gaps. If you think about commodities, on top of that, they have much, much higher volatility than FX, and very often more than stocks. So if we look at oil recently, if you look at palladium, if you look at even gold, actually gold that was boring had over the last couple of weeks massive spike in intraday volatility. Okay, so be careful here. So concentration, diversification. When we're talking about diversification, we want to be looking at the correlation between assets. Okay, so this is a correlation matrix since March 2019, where here we have from here to there all the sectors from the S&P plus the S&P and 3 other assets. So USO, I use USO for WTI, I use gold, and I use AGG for bonds. The whole idea here is to try to understand what is the correlation between your different assets that you have in your book over time. Okay, so if you look at USO here, you can see, and that's the same for XLE, because it has been a dog over the last 12 months, 18 months, and the overall market was up, you had an inverted correlation, okay? And similarly, the gold and the bond have been trending not as strongly as most the equity market. For that is easy to understand. So that means when you had a book, you need to keep in mind which time frame you're looking at. And here, I'm going to go into the next slide. So that's the correlation matrix since January 2020. So since January 2020, it feels a bit like this is the end of the world every 2 weeks. And that means suddenly, instead of having a risk-on market where you, and when I'm talking equities, you go up every day, you get risk-off, okay? So the correlation between those assets, which are stock assets, are going the same way. And then you can see that obviously when equities go down, gold and bonds go up. So if in your book you have long gold and long, let's say, one of these sector, actually you're gonna be able to diversify your portfolio. So you're going to be able to swallow the bumps in the market. So that is called portfolio construction. And again, the correlations are going to be different over time, depending on market conditions. So the basic of risk management 101 is to understand how those different assets, and there are much more than that, are correlated, and how this correlation, which is even more important, will work over time. So you'll have, depending on the market condition, correlation that could be almost at 1. And then when the market turns, those correlation will completely go out of the window. Okay. So next point that actually, I'm not even sure that I should mention that one, because if I look at the last couple of weeks, all of you that are listening today know that, hedging is not for sissies anymore. So if you look here at the NASDAQ composite, we went literally down 2,000 points. Okay, so that's 20-25% one shot. And obviously, when you have this gap, which is an absolute killer, that was on Monday, 2 weeks ago, that is a killer for stocks trader if you're not hedged. So as long as you have those grind and this small correction, if you have a sell-off like this, if you are trading, that's fine because you can go out, there is no gap. But this one, when we go from 9,600 to 9,300, when you have 3% in your face here, that means actually many retail traders and non-hedge portfolio manager or traders were killed on that day. So hedging is not for sissies, and obviously, if you are with me today, that's you knew it already. Okay, here the opposite chart obviously is the implied volatility, so that's the VIX. So the VIX represents the 1 month implied volatility for the S&P 500. So by definition, when the market sell off, volatility goes higher. Okay, so we went from 14% roughly on implied volatility to 48%, and that was even more yesterday. So we closed at 41%, but in between it went above 50%. But think about implied volatility of the VIX over time. So if we had the chart over time, you'll have roughly the implied volatility average around 19%. Okay, so that means before the sell-off, the implied volatility was below the average. Okay, so in terms of risk management, you know that the cost of hedging your portfolio is way lower than the average cost of hedging. Okay, and since its creation, think about 19%. I like this 19% because it's easy to understand, and that gives you the picture about how to hedge your book. So I used these slides and the following slides last week and made a few changes, and I use as well those slides in the 4x4 video series. And it's about the way we do filtering process for stocks. Okay, so we start our universe, when we're starting our filtering process, we will be starting with roughly 2,000 to 3,000 stocks in the US, for instance. And that would be for market capitalization for companies of more than 2 to 3 billion. Okay, so we're going to be starting with the market level. And then slowly we're going to be going into the sector level, industry level, and then to the stock level. Okay, so think about ID generation with 4 different levels. But when we do ID generation with 4 different levels, that means as well we are carrying 4 different levels of risk. Okay, and that means you could end up with different positions. You could be naked long, you can be naked short versus the index, or intra-sector pair trade, or across sector pair trades. And as well having different growth and net exposure over time. So, but think that here we are carrying different level of risk. Risk market, risk sector, risk industry, and stock risk. And how we're going to hedge those different levels are going to be extremely important for our future returns. So I want to make a quick introduction to the CAPM, which is the capital asset pricing model. So when looking at this model is saying when you're an investor, we should be rewarded in 2 ways, which are the expected returns. So there is the risk-free rate, which is here, with the government bond, with the government bonds as the standard. And that is the time value of money. Then we have the risk that equals the expected return for taking additional risk. And here we get the concept of beta, which is extremely important, times the equity risk premium or the systematic risk. So here the beta equals the covariance divided by the variance. So let's take an example. I mean, that's going to be easier and probably less boring. So if we have the risk-free rate as 1.6%, so to give you an example, I've done this slide, I think it was 3 weeks ago. Okay, 3 weeks ago, 1.6%. So now we are at 0.75. Okay, but let's assume that we are 1.6% with the S&P 500 return at 7% and stocks beta of 1.2. So that means as an investor, you want to have an expected return on the stock of roughly 8.08%. Okay, so what is key here is the beta. So, and we already need to make a comment about the way of calculating the beta. So the beta can be calculated in different ways, either on the time covered, like 2 years returns, and on different periods. So to give you an example, I think that Bloomberg is using 2 years weekly, where most people will be using the 5 years monthly. And why is it so important? because it is using past correlation. And by definition, correlation will be changing over time. We all know that the correlation recently have changed versus 3 weeks ago. So as market condition can change, it means that we need to be using a bit of discretionary when looking at beta. Why? Because correlation between assets could suddenly change depending on market conditions and economic conditions. So very quickly, the limits of the CAPM model. So there is a limit, obviously, on the risk-free security, and the moves on the bond and negative yields on the bond tells you that, and even the moves that we had on the Greek bonds a few years ago, on Portugal, on Italy, even Russia 20 years ago, tell us that on a level country, we need to be cautious on the concept of risk-free security. So far, US have been safe, Europe as well. But looking at the way it's going, I'm not sure that we can say without any doubt that bonds are risk-free security. And here the question is not, it's not to be doom and gloom and saying the end of the world is coming. It's just that there might be a good bubble in bonds. And to me, the concept of risk-free security is far from being perfect. The assumption as well that the returns are normally distributed. As you saw over the last couple of weeks, if you do the normal distribution of the S&P, you can see that the moves that we had have been the outliers. So as the CAPM model is based on the normally distributed returns, that doesn't work perfectly. And as I just said, beta is based on past volatility and correlation. So as this is based on what happened 2 or 5 years ago, it could be different of the new market conditions or economic condition. So the move that we had over the last couple of weeks reminds us of first the outliers, first the possible risk-free security, then the risk-free security, and third point that beta could change. So for beta, we could be using regression, as I said, between 2 to 5 years with weekly and monthly data. And we could be using longer period that will be providing board data, but companies, we need to keep in mind that you look at beta for a company versus the index. And the business model of one company could be changing over that period. If you look at Microsoft, which is a good example, from 2015 to 2016, and many of those businesses in the US, companies in the US, suddenly the cloud was getting bigger and bigger. So if you look at Amazon, Microsoft, suddenly the beta is changing because as well, their business is changing. If we are using shorter period, then it's going to be distorted by firm-specific event. And that means we are facing much more noise, okay? So let's look at using the 5 years weekly returns for calculating beta here. So let's assume that we have a portfolio worth $100,000. Okay, this is a big amount for probably most of you, but you're going to have the full picture. So here we are not going to be using leverage, and our maximum gross exposure, long plus short, will be equal to $100,000. Okay, and again, in this calculation, are going to be using the 5 years weekly returns for calculating beta. So we want to have diversified longs and keep a bit of cash and be hedging versus the market risk. So beta works very well when we are diversified. If we're taking 1, 2, 3 stocks, it's not going to be working as well. So think about you have 10 and you're going to have between 6 to 10 positions. So calculation of beta here. So I take those 9 stocks, okay, plus the S&P, NVIDIA, Microsoft, a bit of utility, a bit of bank, those 2. Amazon, I'll be looking at a bit of distribution, a bit borrowing rates, yields, XLU, a bit more active, and the SPY, obviously, which is the S&P 500, which has a beta of 1. And I'm going to be constructing my portfolio based on beta, where NVIDIA 1.88, if I take $10,000 for each position, that's going to give me 3.5 roughly $1,000 worth of NVIDIA and short $6.5 thousand of S&P. So here I'm only trying to put long versus short, okay? And that would be long stocks and short the index. So I just want to be covering the market risk. I'm not thinking about, I want to be generating alpha, long, short in the same sector. Let's think I'm a long only, and I want to be hedged. Okay, so my total exposure, long and short, is going to be my gross exposure, which is $19, and I'm still going to have 10% cash. So literally, this is a book that some of you might have a couple of weeks ago, keeping in mind that we don't have single name shorts here. So how did we do on the first down move, which was on the 24th of February, when the market got down 3%? So here we have our position, and we look at the moves on the day. So NVIDIA on the 24th was down 7%, Microsoft 4%, and the S&P, which is our hedge, was down 3%. So the performance, so that's my P&L based on my positioning here. So $3.4 thousand times 7%, that gives me a P&L or minus 245 on my long. But on my short, I was short the S&P for $6,500 times 3%. I will have made $216,000. So overall, on that day, if I was using hedging through the beta, I would have been down $74. So just take a bit of time to look at this slide, because this is extremely important. If you were hedged beta on the 24th, when the market was down 3%, you will have been down 0.07%. So roughly no move, okay? So some of you might argue here, yeah, but look, Greg, that works perfectly on the day. But I'm pretty sure that the next 10 days, your whole book, the whole portfolio just went through the window. So I did the same, and I look at the beta example for the same portfolio from the 21st, which was the Friday, to the 3rd of March, which was a couple of days ago on the close. Same size, NVIDIA, Microsoft, sectors, Walmart versus the S&P. And I look at the move from the 24th, from the close on the 21st to the 3rd of March. So those are the moves. And I made the same calculation. As you can see, the bottom line is you will have been up $200 or up 0.2%. As you can see, for some, if we do here, if we look at here, we will have been making more money on NVIDIA, but on some others, we will have been losing. So overall, because you diversify, your book is going to do well. From my experience, it works well if you have 1, 2, 3 position, because it is the beta works well when you have enough position for the negative to balance the positive. But the bottom line here is look at these numbers again. Maybe you use Yahoo Finance to go through it again, and maybe through a book that you had some ideas before the sell-off. Overall, the beta worked very, very well over the last couple of weeks. And that tells you that if you went hedged, there was no pain in your portfolio. So obviously, here I'm going to go through different charts, and the beta that is calculated here is the beta on a weekly basis over the last 3 years. And I wanted to show you how beta could evolve over time. So please make sure that if you're thinking about putting a position, let's say, on NVIDIA, and you've done the calculation now, which is at 1.8 roughly, do it in 6 months' time, because in 6 months' time, the beta could be completely different. So as you can see, we went from almost 3.5 times to 2 times. Okay, so over time, that changes. So I use NVIDIA, I use JP Morgan. So I can tell you that the JP Morgan is going to go like this here suddenly. Okay, why? Because JP Morgan has been underperforming massively the market over the last week, and it started really this week, and I've been flagging that up. But here, if you get the great financial crisis, this is literally where you have the beta. So the beta, which was 1.2 times, these days, if there is a blip, then suddenly correlation goes there, And that means you need to reduce your exposure of JP Morgan versus the S&P. Okay, here we have Microsoft. So Microsoft 1.2 goes down 0.8. And as you can see, when the business model started to change with the cloud business from 2015 to 2016, we had a 4 to 5 years massive rally on all those names. And that means the beta of those stocks, Microsoft included, went up massively. If we look at Walmart, Walmart is much more defensive. So that means in a market like this, normally should do better. And this is why the beta is at 0.6. So for some of you that are familiar with it, obviously this is obvious. But for those of you who don't know, that's a way to start. So if you look at the utilities, look at utilities, 0.3 beta, very, very low beta. And here you have Facebook over time that is going a bit higher and higher. So what needs to be done here is looking at the different time frames or period to calculate your beta as correlation could and will change over time. Okay, so if you have questions after this call, please send me an email and I'm happy to answer those questions, because it's if you can start to deal with beta, that would be risk management 101. That would be a good start. So the concept of beta tells you that as well, you need to use discretionary on both the company and market condition. If you think that market condition could be changing, like someone could have done a couple of weeks ago, that means suddenly the correlation of stocks or companies that could be seen as non-risky actually could increase suddenly. So here, I think Deutsche Bank is a good example. So I put the beta of Deutsche Bank versus not the S&P because it's a bit pointless, but versus the stock 600. And I could have done the same versus the SX7P, where you can see the correlation first came down a bit. Then we had really the crisis on Deutsche Bank. So we had all the noise, and what you have is at the top here, many people were telling you buy and put on Deutsche Bank. So when people were telling you to buy put here on Deutsche Bank, you were buying put on Deutsche Bank at the worst possible time. Okay, that means in terms of implied volatility, you were looking for a crazy move, and since then it has been coming down. Okay, and that's a good indication about risk on, risk off as well. So if you can start to understand how this beta works and how the beta has been evolving over time, that's going to help massively to better improve your risk management. So quickly, I want to talk about the 4x4 video series because I think it works well. Why does it work well? Because again, I had many people that have been trying to generate ideas, that have been using different platforms and different video series, and really they have been struggling. And they came to me, and even if I probably sound very boring here, and I said to them, you know, risk management, as long as you don't have a good risk management, you're going to be struggling. And the good thing is, over the last couple of weeks, all those people that were struggling and that have been using the 4x4 video series since October have been doing very well or have been flattish. Okay, so if you are flattish, I mean, that's your worst case scenario, a bit down. And literally, I don't want you in a situation like this to be down than more than 5% over the year. So the 4x4 video series, for some of you, it's about learning how to consistently be making money over time. So I really don't care about the people in January or start of February that come to me and say, look, I'm up 15% and you're a piece of shit because you're not making those returns. I know in the long run, this is not how it works. And if you want to be working in the trading room, this is not how it works. It's literally, I was thinking about calling the 4x4 video series the whole weather process, because you need to be and you want to be making money over time. So this is a very comprehensive online trading course. I spent a lot of time building this trading course. Why? Because I knew that people were struggling, that there were many mistakes that they learned somewhere, and I wanted to help. So it is a combination of a top-down process where we're going to have as well bottom-up ID generation, and what I've been doing as well over the last 20 years, which is active trading and special situation. Because if you are managing a portfolio, if we look at days like those ones, you need to be more active, because when there is more volatility, you need to shorten your time frame. You need to be turning and looking at different opportunities more aggressively. And as well, you're going to be looking at special situation. Why special situation? Because very quickly, if you look at stocks, you're going to come with special situation with, let's say, ADR, with some stories that special situation could be extremely helpful. So similar to what we've covered today, and this is why risk management is key for me, I wanted to teach you how to diversify your portfolio across asset classes, okay? Keep in mind that my background is here, the core portfolio around stocks. But in the long run, you need to understand all the asset classes, okay? Because if you don't understand how the asset classes are working, there's no chance that you're going to be making money in stocks. And you need over time to diversify your book, okay? So then I look at how to optimize the P&L and get a strict risk management. So you can see again how boring I could be. And really important, limiting our downside and improving returns along the learning curve. So what I have here, I know that many people will not going to be listening to that, and they say, fuck, Greg is boring, I don't want it. It's just, I want something that I just want to dream. And then in 6 months, 12 months, 18 months, they will come back at me and say, look, Greg, you are right. And again, if you want to work in a trading room, if you want to have a successful book in the long run, and I'm not talking 3 months, this is what you need to do. So you're going to have access to 40 videos where you're going to have 30 hours of footage and more than 45 spreadsheets. And what is important into this 45 spreadsheet is to build your infrastructure. So you're going to have access to all the websites I'm using. And I don't want you after that to be paying for anything else. Okay, so that will be building your infrastructure. And we all know this is a learning curve. Okay, so to do so, you want to be fully independent and going from there. So quick examples, those are the videos. If you want to see the testimonials on the website. So here quickly, how it is articulated. First, we'll be looking at why we might be failing, understanding the GDP, asset allocation versus economic cycle. And here, this is something that we already discussed today. Expected returns versus realized returns. So that will be implied volatility, ATR, historical volatility, macro analysis. And again, my background is equity. When I started to trade equity, I was literally trading equity, looking if the stock was going up, I was buying, and then selling when it was going up. Then I realized years after years that you don't need to be the best in macro analysis. You don't need to be the best at analyzing a company. But if you don't have the basics, there is no way you're going to have a good risk management and you're going to hold the position. So by doing a macro analysis and understanding what are the drivers, you're going to be able to build a portfolio. Okay, and this is where you go into the ID generation based on those different filterings. So those different filterings, you don't want to be stuck in one filtering where after 2 minutes you only be looking at 10 stocks, 10% of your universe. You want to be building a strong watch list week after week or month after month, depending on which time you have. And then when you have your IDs that goes into your watch list, what is important here, this is risk management. They are not trades yet, okay? So you want to make sure that the technical analysis and the price action are in your favor, that you can put the position, and that you have a clear and strict risk management. If you don't have the risk management, you can have an ID, but don't put the trade. So that will be like today, oh, I want to be short volatility because, it sounds like a good idea when the world is panicking. Go for it. But if on Monday or Tuesday, the VIX or the implied volatility is spiking in your face, you're going to be stopped out very quickly. So if we look at a couple of weeks ago, the best way of doing the risk management was to hedge your book through options. Why? Because implied volatility was very cheap. Now, if you had a book, you switch most of your hedging from options to ETF or futures. Why? Because implied volatility is so high that you need to cash out on the premium. Okay, so that will be here. looking at the P&L optimization. So to implement all of this, I do the mentoring program. So the mentoring program, and I know today that there are many of you that were part of it. So it's 12 weekly one-to-one online session over 3 to 5 months, where I help you to build a proper infrastructure to support your trading process and become independent. And I really say that again about becoming independent. I know the struggle for all of us is trading, portfolio management, is you have a lot of noise, but at the end you're making your own decisions. So sometimes you can feel a bit lonely, and this is why you need to have this strong process, this strong infrastructure that you rely on. Otherwise you feel like, you know, you're betting and guessing every day. And here you're going to be first interpreting the macro indicators to generate quality trade ideas across different asset classes and regions to profit from macroeconomic trends. Bottom-up analysis, active trading, and special situation. And the whole idea, and here, I mean, obviously it's easy for me to say that, and it's harder to do, and it's an endless process. It's consistently generate positive returns by building a balanced portfolio using different asset classes, timeframes, and strategies. So if you have any questions, please send me an email, the same email going on the website if you want to have the ATR daily calculation spreadsheet. So the conclusion for today is, before doing anything, we should start with the risk management before putting any position. Again, that sounds boring, but if you don't have the risk management, you get no chance. And I think what is key is we don't need to lose 80% of our money to do it. We don't need to lose money by using dodgy people to try to teach us to do it, or by trading. So think it's pretty easy. First, about leverage and concentration. I think why people are so bad at risk management when they put their money at work in the equity market, stock market, or bonds, is they think this is different from their day-to-day life. And actually, I'm surprised that people will be thinking well when they put money in their daily life, and when it's about going into the equity market, they do completely differently. So it's like, you know, people that outside of a stadium, a football stadium, are pretty normal, and when they go inside the stadium, they go completely banana. So here, depending on our macro view and our market's condition, we will and we could decide on different levels of exposure, from net exposure to gross exposure. Okay, so that's something that is well covered in the 4x4 video series. You have to learn. If it's not the 4x4 video series, that has to be somewhere else. I don't care, but learn somewhere. When volatility spikes, as we had over the last couple of weeks, you do not need to be a hero, and you should reduce size. Okay, there is no point of saying, oh, I've been the strongest, and after 2 hours, actually you're out. What I wanted for you to see today is, even if it's not perfect, because there is a lot of discussionary and there are some, let's say, some issues with the CAPM model, beta will help massively to reduce risks, at least first. In the same time, we know that they have many tools to hedge our portfolios, from ETFs to options, and we should be using them. I didn't have the time to cover this today because we are already 1 hour into this call, but that's something that you should be looking at. But the last thing that is key to me, and all my mentees could confirm that to you, for risk management, you need to have a hard stop loss and do not mess with it. Okay, hard stop loss, do not play with it. So thank you for taking part in this webinar. Be safe. I know it's a tough market, but there are many opportunities. But to grab those opportunities, you need and you want to be still and to be in the game. So that means you need to have a good risk management. So don't get confused on people telling you, I've been down, I've been up X and I'm taking this position, because I know for a fact that over time it could be very disturbing. When the assets are moving big time, we are always thinking, okay, I should have done this and this. The reality is much different. So probably one of the next webinars that I'm going to do is going to be around trading psychology and how to try to avoid those noise and being, let's say, focus on what we should be doing. If you have any suggestion, as always, I'm very happy to have your feedback on both this webinar and what I could be doing in the future. Feel free to contact me and feel free to send me an email if you want to have this spreadsheet about the idea. Again, be safe. The market is really, really hard. You're better off having a good risk management and making sure that you learn before putting position. Have a good Saturday, good Sunday. Thank you, and talk to you soon, hopefully. All the best. Bye-bye.